Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. We did not coordinate our shirts here today. I think we just both have a good collection here of FEG Blue.
We're ready for our best buy shifts.
Oh, Andrew's always good with a zinger. Count on him for that. We got a couple of topics for you today. We're going to talk about manufacturing activity in the U.S. Certainly a relevant topic from all that we've gone through macroeconomically this year, and look at tariffs, that sort of thing. And then we're going to take a look at international fund flows and give you an update there on where money has been moving around the globe so far this year. So we'll just start right in with the U.S. manufacturing. And I found this super interesting and can get lost in the narrative for how we talk about manufacturing in the U.S., which when it comes up and we discuss it, we tend to think of us as a non-player as manufacturers around the globe. But I think that stems from the top chart. This has got two components here. The top chart, the blue line there, shows you the percentage of our jobs in the U.S. that are manufacturing. So if you go back into the 1940s, we had approximately 40% of our workforce in manufacturing. I think most of you would just understand that from whether it's your family lineage or whatever. And through time, we have steadily declined as a percentage of our employment that is in manufacturing. But meanwhile, the orange line, that's the part that gets lost. So even though we have seen a steady decline of manufacturing in a relative sense from our workforce, productivity gains have just continued and led to a 12-fold increase in our manufacturing output. So not only that, but if we take a look at largest manufacturers around the globe, the bottom panel, China surpassed the United States 15 years ago. And so that's kind of a foregone conclusion. They are the world's largest manufacturer. But the U.S. also has no real close competitor for third. We are still the second largest around the world. I just think that's some interesting context as we take a look and we think about what we do here in the U.S. Economically. So that's the manufacturing slide. Andrew, I'll pass it to you to talk about fund flows.
Thank you, Adam. So when we talk about fund flows, that's just a fancy way of talking about where money's going from one place to another. We know that as we see more money flowing into certain sectors, that's going to make them go higher. We see a lot of money flowing out of certain indices, that's going to make them go lower. It's pretty basic concepts, right? And so what we want to know and what we often track every week, are we seeing more money going into the market? Are we seeing more money coming out of the market? And then specifically, which markets are the ones seeing those inflows and outflows? So the chart that I'm going to discuss this week is looking at what money is coming in and out of both domestic ETFs and funds, and those that are non-U.S., those international funds. And what we're seeing is a big shift. And this is a topic that we've discussed a lot on the Market Carver. We've talked a lot about the increase in interest internationally as we start seeing foreign markets really start to perform and actually start to outperform the U.S. market. And so what this chart's looking at is a 2-month rolling average of funds in red going into U.S. funds, and then in the gray is the international funds. And so when we look domestically, it's roughly flat at $13 billion. I know that sounds like a big number, but relatively it can be a lot more than that. You can see it's been declining for most of this year. And while the opposite is happening internationally, we're seeing now we're moving almost to $100 billion going ex-US as we continue to see money leave the US and start going towards those international markets as investors start seeing more opportunity in places like Europe and Asia and in the Middle East and all these different countries that either are less exposed maybe to some of the macro headwinds we have in the US, looking at valuations, they're maybe less stretched, looking at currencies. There's all these different inputs that are starting to make international markets look more attractive. And we're seeing the money really is starting to confirm that as we see flows really going a lot more international. Now, what's the implication for that? One, it allows us to increase in diversification where we're able to start looking and get paid for the risk of looking internationally. And then the downside to it is because over the last decade, so much money has come into the US market, If we start seeing that teeter-totter that's been really unbalanced as everyone's come to US, if that starts to unwind, then we're going to start seeing more selling pressure in the US as those dollars leave to go elsewhere and could put pressure on US markets. But right now, we're still seeing flows come into the US. It hasn't gone negative, but we are seeing a lot more attractiveness, at least from where investors are parking their money in non-US funds. Pretty interesting. It's a big change that we haven't seen in quite a while.
Oh, absolutely, Andrew. And one thing we don't have a chart for here, but I think it's always good to come back to is our risk barometer. For those of you that don't know, Andrew's been with us for a long time, over 10 years and counting now. And he's the brains behind our risk barometer, one of the key inputs into our portfolios. So I think it would just be helpful as we've seen, whiplash in the markets with a steep decline and a steep rally. Just give your idea on the components that are going into it and then where we sit today.
Yeah, exactly. So the risk barometer, like Adam said, is where kind of the gauge that we use to manage if we want to be really aggressive towards our equity positioning or towards just the general risk of the portfolio or less so. And we saw several weeks ago that dial got moved to defense, and we made the appropriate decisions and changes in the portfolio to reflect that. Now we're starting to see the market has recovered, and we're now watching, are we potentially going back to offense? And there's three main inputs to the risk barometer. To discuss them broadly, one is just simply the trend of the overall equity market. Are stocks, are the indices going higher or lower? And we measure that quantitatively, looking at purely looking at the data. Another input is looking, again, like I just discussed with fund flows, is looking at the flows data. Are we starting to see more money flowing in or out of US equities? And the third input, looking at the fixed income market, looking at things that are more economically sensitive, and are those looking positive or negative? And we saw those turn negative several months ago, and now we're starting to see actually one of them has turned positive. The fund flows data actually went positive a couple weeks ago, and now we're starting to see trend is getting really close to flipping back to being positive now. And again, the risk barometer is not meant trying to time the top of the market, get in at the bottom. It's simply trying to look for the most opportune times to be on offense with our equity positioning and when to be on defense. And those are going to likely be after the market's already made that top or made that bottom, as we're trying to look at when is the most ideal time to really push on the gas within the equity market, or really start to look at pushing on the brake when we start things to look a little bit riskier. So we are seeing the equity market starting to recover. At the time of this video, the S&P is back to about where it was at the start of the year. And so we're continuing to watch the data, continue to be reliant on the data for how we make those changes going forward, both in the risk barometer as well as the other components of your portfolio.
Very, very helpful. So thank you for that. And of course, thank you to all of you for writing out another video with us. We sure do appreciate it. If we can be of service, whether we have the pleasure of working with you now or we don't, either way, feel free to give us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks, and have a great weekend.